Well, today is Saturday, the 8th of September 2012. Let's take a look at the gold to silver ratio, and we'll start back going to 1968. And this is a 113-day time frame. This is about 250 days in a year. So this takes us back to 1968. The gold to silver ratio is taking the price of gold and dividing it by the price of silver. The highs and the lows, you have the high here of a little over 100 and a low of 13.99. Now this low occurred in, let's go find the data. The more info link, you go to data. This is gold, silver, and the ratio since 1968. So if we want to find where the low occurred, it was in 1980, and it was the first day in 1980. On January the 2nd, the price of gold was $559, and the price of silver was $39.95. Therefore, the ratio back then was 13.992, and maybe within these days it might have been lower. I don't know, but this is the best that I got. Since this time frame, silver today is a little under 34, so that's down about $6, or a little over 15%. The price of silver is down since this point, and the price of gold is pretty much tripled. So that's the data. You can find it in the more information box, as well as all the charts that are used within the video. Find the date, and you're ready to go. Alrighty. So since we hit this low and this high, you had this support area which followed with a lower high. It then followed with another support test of the exact same area at around 47.5. It had technically a higher high in here, but I'll consider it a matching high because it's relatively close to the previous high. And then in 2011, it broke support right in here. And it came relatively close to the lower level of 29.75. It never did go below 30, but it did go to around 31. And since this point, or the last three candles since the breakdown, it has managed to get back above this level, looking to make a lower high from this previous level. So what does this tell me? This tells me that a big move is ready to occur. And this is probably within the next 6, 7 periods. Therefore, I can multiply that by 113 days. We're looking at the next 3 years or so for the big move. So why would a big move be looking to take place? Well, you have this break below, and now you have this possible failed breakout above this level. A failed move above here and falling below into the low 40s should be telling us that not only would there at least be a test of this 29.75 area, but it could also very easily take that part out because we've already had a decent test within this level. Now, on the contrary, is this failed move going to be this breakdown below here? And oftentimes failed moves can create fast moves in the opposite direction, and that would mean a test of the upper around 100 area. I think the first one is the more likely scenario, that the gold to silver ratio will continue to head lower. Let's now shorten out the time frames. So we need to know from this low, but which high would be better to use? We could use this high, or we could use this high. I'm going to use this one in here because it's really one leg that went from point A to point B. So we're going to take a look at the gold to silver ratio now. We're going to take a look at it from 2008 with those highs and those lows. All right. So this is that high of 88. This is the low of 30 and change. And what occurred is you found some consolidation up around the first level. Once you broke it, fast move up to here, consolidating within it. You have a second test of this area. And now it's breaking down, and for the first time using this time frame, which is a 292-hour chart, it looks as if it's changing the trend. We're below the 18 average now, having a clear breakdown below it, but it has just obviously occurred. Any lower high that may occur that follows with a lower low, even just something like that, then it's almost a gimme that the next level of 46 will be that of tested for a move to be a failed move, which is a down move from point A to point B, that it needs to hold and break and hold and stay above this level. As of now, that hasn't happened. So when you start to see this in this area here, then this will tell us that the bear market would be back into full swing. As long as you're in the middle parts, which has been the case since it's been in here, you are in the neutrality camp. Okay, so now let's change this up a little bit. Let's take a look at this from point A to point B, a different one. We'll say this is point A, we'll say this is point B. So we'll look at this low again, and we'll look how this works from this low to this high. And to do this, we will take a look at the, which hour we're going to do. It's the 103-hour time frame. So this is the low. This goes back to the start of 2011. And again, this high. So again, we look at this little area here. It was very close to finding support at this Fibonacci level. And we had, of course, pretty close to a matching high in here, technically a lower one. But what's important to note is how this AT moving average is holding up, because it's not holding up well right now. You had this little candle here which broke below it, and then further through with really two more confirmation candles going towards the downside, which has put this in a downtrend. Now the last time this occurred was in here. You had this downtrend, didn't last too long. The only difference was usually from failed moves could create fast moves in the opposite direction. Well, this failed breakdown really didn't cause that great of a fast move to the upside. I'd still be looking for support to be found within this level, and maybe find some sort of a lower high up towards where we are now, so come down, something like that, and then maybe take it out. But because it already had that test in here, or pretty much a large pierce above anyway, you have to be a little bit cautious that this area may not be support. And if, of course, these areas are not support, you look for this area to be resistance, or maybe a fast move to the next level in at 39.82. Okay, so now let's take a look at it from these last 2 points here, which is the final one that we'll look at. This is going back to pretty much the start of this year. And I originally showed this in here where we were possibly at an area where we might find support. And well, what occurred is it broke down. We find resistance at this level. And now, on Friday, at the end of the day, it had broken down below this support line, but just barely for now. What's important here to note that is if this area is not support, or the resistance really doesn't get us too high, maybe no more than this area here, and it's continued to go lower, then it will tell us that from point A to point B is a failed move, because it is stagnant, holding below the second Fibonacci line of 51.83. And if that's the case, the bear market would be in play. You'd be looking for some sort of confirmation to have at least a test of this 47 level. And when we take a look at this from the more larger point of view, that if we do have this break in towards it here, that we could very easily see this thing trade back into a bear market. It's been choppy for quite some time, because you're above this, below, above, below, above, below. So that's something else to keep in mind. But quite frankly, the choppiness could only stay for an okay amount of time. It's been about 20 years plus. And thank you for tuning in, and have yourself a great weekend. Bye-bye.